Today we're looking at the SCHD Dividend ETF listed on the New York Stock Exchange. We'll go over the ETF fact sheet, including the management fee, the index the ETF tracks, dividend yield, payment frequency, and the fund's performance. Dividend ETFs can save investors a lot of time researching dividend-paying companies and save the potential headache of owning individual stocks, keeping up to date with the latest news. SCHD is an ETF provided by Charles Schwab, who own and operate the fund. Charles Schwab are the ones who actually own the underlying shares in the individual companies. So when we buy shares in the ETF, we buy from Charles Schwab, who continually issue new units in an open-end fund and not the individual companies inside the ETF. SCHD aims to track the performance of the Dow Jones U.S. Dividend 100 Index, which is an index focused on the quality and sustainability of dividends. It invests in stocks selected for fundamental strength relative to their peers, based on financial ratios typically characterized by higher dividend yields in the US stock market compared to the broad index. It pays distributions, which are dividends from the ETF, 4 times a year with a yield of 3.3%, which would equate to $3,300 of dividend income for every $100,000 invested. It has a management expense ratio of 0.06% per year, so for every $100,000 invested, it will cost $60 per year, and this fee is automatically subtracted from the ETF unit price, so you won't actually see any fee transactions being taken from your brokerage account. Now, since this ETF tracks the large US dividend companies, it is heavily tilted towards financial and IT companies. The largest portion of the fund, at 17%, is industrials, followed by financials at 17% and healthcare at 16%. Materials and utility companies make up the smallest percentage of the fund, under 4% and 1% respectively. Since inception, SCHD has had an average annualized return of 13.3% before tax, which includes both capital growth and distributions or dividends. Past performance is no guarantee of future performance, but it's a good sign of improving business fundamentals, continually driving each individual stock higher within the ETF. With dividends reinvested, the cumulative returns become much higher. Reinvesting these dividends creates the larger compounding effect, exponentially increasing our returns the longer we have our money in the fund. This is the sort of approach I take investing for the very long term using ETFs, to one day live off the investment portfolio as passive income through dividends or selling down small parts of the position.